Hello and welcome to Integrity365 Financial Insights Podcast, our first recording for 2025. My name is Nicola and I'm joined by my colleague and fellow independent financial advisor, Sam Lane. Welcome, Sam.
Hi Nick, great to be here today.
Thanks for being on with me. So as you know, the autumn budget has stirred quite a lot of discussion. And the tax year end deadline is approaching 5th of April 25, and there's been plenty of change. So today we want to discuss some of those areas and focus on what you can do now to optimise your planning before the tax year end cut-off. So we'll cover some of the most popular planning measures, but please note this is not an exhaustive list.
That's right, Nick. So I think we'll start off just with what I probably determine some fairly basic kind of housekeeping bits, sort of kind of use them or lose them allowances that come and go each year. But before we get into that, there's one area I wanted to highlight for people, which is national insurance contributions that affects your state pension entitlement. And there's one sort of deadline that's approaching the end of this tax year, which is just for men born on or after 1951, that's April 6th, and for women, same, but 1953, is that they've got until the end of this tax year to make up any missing national insurance gaps between 2006 and 2019. It's really easy to go and check. You can do it on the government website or even via their app. But if that isn't done before the end of this tax year, thereafter you'll only be able to go back 6 years in time for each year. So that one is quite important, particularly for those kind of approaching retirement. I guess I think that's the one that could be really punitive if it's missed.
Yeah, no, you're absolutely right. It's often something I send to my clients actually is that government gateway ID link to go check. So no, that's a really good one. Easy way to start. So yeah, thank you for that. And what else? So obviously some of the basics is the ISAs and pension allowances.
Yeah. So sorry. Yeah. So ISAs, we've got the standard £20,000 each, and that can be cash or stocks and shares. And then got JISAs as well. So that's junior ISAs, slightly reduced allowance of 9,000 there, but still, very attractive. Again, that's a use it or lose it, and there's you can't go back or forward in any years. Yeah, anything else in that area?
Yeah,
Just
so
kind of
they're probably
basic
the
housekeeping.
most used two, aren't they, really? And you've got
Yeah.
many versions of those in between. But in addition to that, we've got the lifetime ISA. So something that I know the last few years I've spoken to clients a lot more about. So that's a £4,000 allowance each year with a up to maximum bonus of 1,000 a year. So that's a good one to try utilise before April. And flexible ISAs, again, something that's only really come into fruition in the last few years. And if you have taken money out of a flexible ISA, it's good to check if if you can afford to try and get that money back in before the tax year closes.
Yeah, cool. Actually, you're right. And actually, a couple of my clients have used that. That FlexLife is a really good initiative. When it first came out, actually, there weren't many providers that offered the flexible function, and I think almost all providers now offer that as standard. There might be a few that don't, but generically, certainly providers we recommend, I know they've got that functionality. So if you're unsure there, I think you know clarity, then speak to your advisor. Reach out to them now before we do get right into the end tax year end.
Yeah, just double check with your provider, as you say, a lot, but not all. No, that's a good one. Thank you. And pensions, always a tax year favourite. And
Yeah,
even with the budget changes, still really topical, still really tax efficient, and something that I'm encouraging my clients to look at before we get to April. So do you want to talk us through some of the bits you're looking at with your clients, Sam?
yeah, of course. So, as you said, lots of changes in the pension landscape broadly, but actually the tax year end specific bit is actually unchanged largely. We've still got the same allowance, so that's up to £60,000 or earnings, whichever's lower, yearly earnings. So that's unchanged. The only difference is you can go back a few tax years. Again, that's something to speak to your advisor about, get into detail about on this conversation today.
Yeah, carry forward exercise is really good, especially for those coming up to perhaps nearing their retirements. They're often at their higher earning levels, often not far away from accessing the pension. So it's quite a neat way of getting extra tax relief in at the end of your, not just at the end of your career, but certainly that often is a common time I speak to clients about it. And of course, don't forget those who don't necessarily earn. So whether you're retired or whether perhaps it's a pension for children, you've got that 3,600 gross per annum you can put in each year. And that's often quite a good planning tool for various types of individuals, I find.
Yes, that's that 2880 net figure. So the contribution back to 2880 and then sort of 720 is the tax relief on the top. Yeah, bang on.
Year in tax relief isn't to be missed. Worth going.
No, not at all. Again, it's belt and braces stuff, isn't it? But it's easily overlooked, which is just that in itself can be the advisor can earn his salt actually, or her salt, just on that alone. I guess the other bit in pensions, which would be kind of remiss to address, would be that the hike in national insurance that's come in. So that doesn't affect us as individuals in a personal capacity, but it's a big impact for employers. I think the only thing I wanted to just mention on that area really was that those businesses that aren't already doing salary sacrifice, I'm not going to the mechanics of that now, but if you're not already doing that, your companies aren't doing that, then you should really review that, because that could reduce the impact of the national insurance hike on you. It reduces your NI bill. It also reduces the most employees' national insurance bill as well. So for those who haven't looked at it before, please get in touch and we can review it for companies. And even those companies that have looked at it and discounted it before, it's definitely one to revisit.
Yeah, very timely this year. No, that's a great one. And of course, the other big change in the pension sphere is the potential for inheritance tax from April 2027. Quite a big change since pension freedoms in 2015, and certainly I know it's affecting the vast majority of my clients. I'm sure you're the same, Sam. So I've started having those conversations. But as you know, it's not coming into force until April 2027. What are some of the planning measures, Sam, that you've been speaking to your clients about with this change coming up?
So we haven't seen the clients. We've also had some technical help from some colleagues in the market, some sort of large providers. We both met one yesterday at a kind of a joint meeting, actually, didn't we, yesterday? I think the first thing people should remember is what hasn't and will not change is that pensions are going to remain the most tax efficient vehicle for people to save for their retirement in. That is going to be unchanged. Where there is a change and why the government's potentially taken the direction they have is that pensions, in my view, probably as a byproduct, have become a really, really, really good tool to transfer wealth intergenerationally, and that's really what the government and revenue are trying to track balance. So if you want to save for your retirement, great, but if you're not looking to take it out ever, that's the sort of the loophole, if you like, they're looking to take away. So from a client perspective, the main message, I think, as you already referred to, we're trying to get across to clients is for now, it's probably a case of wait and see, because we had, I think it's the sort of end of January, I think it's the 26th, I could get the date wrong, but
yeah,
22nd, there we go. I knew I'd get the date wrong. The consultation period had closed. That was a period of time where largely providers, so people like Aviva and Aberdeen and AJ Bell, would have had a chance to go back to HMRC and give their input on the proposals. So that's happened now. But from the discussion we had yesterday, we were hoping that we might hear back on that consultation maybe in the spring, kind of in the new tax year. We're now thinking that might not happen until quarter 3, possibly even quarter 4 of this year. And truly, until we know the detail of that, we cannot give sanguine advice to people. So it is near wait and see. It's because the worst thing in the world would be to do is to make some changes that are irreversible, and then the legislation doesn't change, or actually something happens between now and 2027, and you put yourself in a worse position. So we've got plenty of time and plenty of tools available. So pensions are great, as we've already mentioned already. But we have got other tools available to us in terms of the inheritance tax piece. So things like whole of life, so that's an insurance product, offshore bonds. I think we might chat a little bit later about the option to gift sort of surplus income. And there are quite a few more, lots of trust-based solutions. So we've already got a really large toolkit. And I think what's going to happen over the next few years, probably from 2026 onward, is we're going to see that need for advice increase. But advice people are going to get is going to be much more personal to them, i.e. much more bespoke. Because it's not going to be a one-tool solution, i.e. it's all in the pension, nice and simple, done. That's not going to apply anymore. So it's going to be a case of using quite a few different tools or products in varying ways in each different scenario. Have you started to have those conversations with clients already, Nick? Or
Yeah, so quite a few clients I've calculated inheritance tax changes, or rather inheritance tax liabilities pre-budget, and then what they may look like post April 2027 should the changes go ahead as proposed. And often these figures are quite shocking for a lot of individuals. So I think the key, as you were sort of talking through there, Sam, is to be informed, have the review with your advisor, know what it looks like now and what it might look like in the future, and start having the discussions about what you might do. There are small planning techniques you can start doing now, but I would say it's probably beyond the scope of this podcast and more for an individual consultation with your financial advisor. Getting informed on your position, what it's going to look like, talking through what those possible strategies might be. Maybe some of them may be started soon, depends on which one. But throw a bit of caution to some of those larger withdrawals, unless it very specifically suits you, which your financial advisor should be able to, help you with. Change of behaviour really is just going to be encouragement of releasing pension funds and spending that money one way or another, whether that's on physically spending it on holidays and goods, or whether that perhaps is passing it down a generation. I think that's going to be the biggest.
I think you're right. It's probably going to bring forward decisions a little bit, but as ever, tax shouldn't rule our lives. So, if you've got things to do, you want to do, get on and do it, talk to your planner, and we'll find the best solution for you. I guess the other thing that's coming down the line is in 2026, so before 2027, but not this tax year, but the next tax year, we've got changes to agricultural relief and business property relief as well. And again, there's another consultation on that. That hasn't reported back yet. We do expect that one probably after the tax year, so some point in quarter 2. And there's a real that legislation really does intertwine with that pension piece in 2027. So again, really, really difficult for us to make recommendations before we know what the legislation is going to be and how those two cross over. And I know with your background, and a lot of your clients are in the sort of farming community. I haven't personally got as much experience or exposure in that market. How have those kind of conversations been going over the last weeks and months? I saw in the press on Monday that a lot of tractors were held up in Parliament, making their feelings known.
Yeah.
Where are you with that? What are your plans with that?
It's obviously a very emotional subject for a lot of people. Again, I've encouraged anyone in that position to really start that conversation early. You may not take action now, but again, a bit sort of similar to the pension discussion we just had. We can figure out what the position looked like before and what it's going to look like with these changes, or potentially look like with these changes. And then start talking through what some of those solutions might be, and what other professionals they may need. So often it's not just a financial advisor. You may need an accountant, a good lawyer or solicitor. It's good to sort of have a team around you. So the earlier you start with that, the better. We're watching out to hear more. I'm just encouraging anyone really to start discussing it soon.
Yeah, I think you bang on in terms of the start. We already know what the options are going to be. We just can't pick the right option until we know what the legislation is. We're really working at broadening our professional connections as a service. So we've got links with specialist agricultural accountants, for example. We're trying to broaden that base, and solicitors as well. So we can put clients in touch with the right people to help. And there's a lot of collaboration in that area. I know you do bits, and I've got something at the moment with an accountancy for considers. We really can help and want to help and get the very best outcomes for clients in that, in all those areas. But as you said, at the moment, it is considering what's available, but probably is a wait and see.
And also just to be understood, I think, you don't want to feel alone when you're facing that bigger change.
Yeah.
And it can feel quite a foreign subject to some. So just feeling like you've got professionals you can lean on that understand your situation, I think is really helpful and comforting. And often useful to involve the second generation if you can. It's not always appropriate, but often these things are a family affair. So, talking as a family can be really helpful, or partners or friends, however that business is set up. But it's a really interesting.
Yeah, and I think
I love doing.
that's what I think there's a real what's the word? There's a real of the same conversation in the pension sphere, actually. A lot of clients have probably got more sort of surplus capital than they thought they would, and they would need, and they want to pass on to the right next generation, and they thought they'd probably detect that via the pension, i.e., give him with a cold hand rather than a warm hand, but crudely. That from 2027 is not going to be an option. So it's going to bring forward those conversations that maybe are quite awkward to have. Awkward for sometimes clients to have together as married couples, and as you say, bring next generation. But actually, you probably get a better outcome by getting on and dealing with it. And that might be one of the positives of kind of legislation, is that people start opening up and talking, and that leads to action, I guess. What do you think about that?
I'm glad you've given us a silver lining. I think that subject is a bit gloomy, so I'm glad you found one. That's good.
I'm a positive guy, so that's to put a bit of a spin on it.
Yeah, and talking of business reliefs, it's probably a neat time also to just consider those tax efficient investments as well. So some tax efficient investments will give you some inheritance tax relief. But it's not just that. You can also potentially get income tax relief or capital gains relief, depending on what we're looking at. Venture capital trust, for example, that sort of season, if you like, is going to come to an end pretty soon. These various, or rather, they have various amounts of subscriptions they can take in one go. So once they're closed, they're closed. And if you are looking to invest into any tax efficient schemes, it's always worth reminding your clients before those deadlines, isn't it, Sam?
Yeah, it is. And the business relief is probably one that's maybe not been at the forefront of the press, and I haven't seen as much mention of it. It could have quite a big impact for small business owners. So for those businesses, small businesses that are looking to sell, the rate of what was entrepreneurs relief, which is now called, remind me, Nick, what it's called now?
Business asset disposal relief.
It's such a catchy title that I always forget the acronym. Apologies. But those rates are increasing. So business asset disposal relief is going from 10% now to 14% in the new tax year, and then up to 18% from 2026, 26, 27 onwards. So you've got kind of us going up. So what does that mean for people? For a lot of people, not a huge amount, but if you are looking to sell a business and you know you're going to do that, or you're thinking about it, what it does mean is you probably want to expedite that transaction as quick as possible. So, in reality, it's the 12th of February now. Unless you're a long way down the process already, you're not going to get the sale in this year at 10%. But there's enough headroom there, enough time available that it'd be worthwhile getting it through at 40% in 25, 26, as opposed to waiting another year and it'd be an 18%. So again, another example there where the government is kind of encouraging us to make decisions.
No, absolutely. I think it brings a bit of a theme, isn't it, with this episode? Brings forward conversations, looking at planning early if you can. See that, it's a lot to hit business owners in one go. We've talked about business relief changes, we've talked about national insurance a little bit. And now we've just talked about business asset disposal relief. So there's lots for business owners and I suppose shareholders to consider there.
What the government are trying to achieve is they're really pushing that growth agenda, and some of that's got through us all spending, and they're effectively trying to incentivize us to spend money that's locked away in savings in a variety of places, be it pensions or in land and property, and get that money spent in various ways that will help the economy, but it will bring in more VAT, more income tax, all that sort of good stuff that the Treasury desperately needs to improve the services, the healthcare, but the services we all kind of rely on day to day, I suppose. I think as well as business asset disposal relief changing, capital gains tax, that's another area. That is, again, a bit of a belt and braces housekeeping.
Yeah, absolutely. It's a good one it's a really good one to double check this year, because unusually we have different rates halfway through the year. So capital gains tax rates have increased as of the 30th of October. So the basic rate was 10%. Post 30th of October, it is 18%. For those on the higher rate, it was 20%, and post 30th of October is 24%. So and I certainly have some clients who sold assets pre-October and some post, and so worth checking those differences in rates, and something just to be mindful of and careful of. If it's residential property,
I was going to say, you've got another rate again at residential property, right?
I mean, that's not changed, I suppose. So that's at that high.
But it's another
rate to remember, I suppose. And then what else there? Of course, you've got your capital gains allowance. So that is £3,000.
That hasn't changed. That's stayed the same, which is not very generous. It's been the same for a couple of years now. So that's kind of fallen away from 12 all the way down to 3 now, isn't it?
Yeah, so it's halved, hasn't it, the last few years?
Half and half again. So it's really shrunk.
So it's making it, and certainly for me, I've got quite a lot of clients with share portfolios, money in various sort of general investment accounts, and previously those fund switches, those bed and ISAs, relatively doable within those allowances, but now it's getting quite tricky, isn't it? I think this conversation of a slightly wider net of different investment products will become more and more appropriate. Some make an argument for the types of funds you're holding changing, but again, it depends on your viewpoint on that one. And I know we've already covered ISAs, but actually it's worth saying, bed in ISAs, so doing your ISA contribution every year of 20 if you haven't got the cash, but you have perhaps got other investments that are less tax efficient, always worth considering moving some, or almost always worth considering moving some into your ISA as another way of funding.
If you've got ISA wrapped investments, getting them into the ISA environment really is probably the only thing that's in the sort of no-brainer territory in the advice world, I think.
Yeah, yeah.
Yeah. So for that, don't think we'll stick our neck on the block too much with that statement.
Yes, everyone's individual, but popular or most common.
Yeah, yeah. And then I guess just going back to a point you made earlier, I suppose with those changes in CGT rates, particularly mid-year, I'm seeing an increase in number of clients that's in a concern where they want the comfort as much as anything of engaging with an accountant or at the very least a bookkeeper to make sure they've got that, their return numbers accurate. Are you sort of seeing that as well?
I think it's I am, and I guess more people are falling into chargeable territory. So that's
Yeah,
part of it. And it's just more complex as well. So,
yeah,
and actually, after what had been quite flattish performance for a few years from various market forces we've all been through, it has been wonderful to see for 2024 that most of our clients have had a good year of investment performance.
yeah. That's 2 years on the bounce now. Actually, it's been pretty turbulent over since 2020. We had an awful lot happen in a very condensed period of history. But yeah, the last
So that
2 years have
offers
been a bit more steady as she goes, and I think that's probably the outlook for the year ahead. I won't go any more than that because it's not the time and place for that. But yeah, I think we're ending this year and starting a new one with a good amount of more than hope, I think. But really, the outlook looks not stellar, but it looks, we're positive, I think. Yeah,
more buoyant.
moderately bullish.
Um, so capital gains, something to really try and manage, and if anything, the importance of managing it has only grown over the years, and certainly further since the budget changes. One
Yeah.
that I'm conscious we haven't tapped into yet on this episode.
Well, I think the one bit I would say that's reminded, this isn't applying to anything in particular, but going back to the pensions area and indeed agricultural relief, and for a long time, with the exception of a little tweak to capital gains tax here and there, the kind of pillars of allowances and financial products and tax wrappers hasn't really changed for the last decade. There's a huge amount of change coming ahead, and this is the first Labour budget of it, not the last of the Parliament. So we may see some more change. And so I think we're going to really see an increase in, I mentioned earlier about advice becoming more bespoke and being more products available. But more than that, actually, I think what we're going to see is we're going to need to see a diversification in tax wrappers. So that's the type of account where any money is held, not just the underlying investments. So because we don't know what this government's going to do, let alone the next or the one after, maybe having all money in pensions, all in ISAs is maybe a bit remiss. Maybe we could look to, in all cases, to have a combination of tax wrappers deployed to protect against legislative change a little bit. Certainly something I'm going to be thinking about in the years ahead, more than I have in the past.
I think the diversity has always been key, hasn't it? And it's just
Absolutely
become more important. And another topic to talk about for tax year is inheritance tax planning. I know often not typically associated with end of tax year planning, but it is tax year sensitive and something to consider with your advisor, isn't it, Sam? Each year, again, depending on your age and your position. Perhaps if I just talk through some of those allowances and strategies that are.
Yeah, absolutely. It's a bit like your ISAs. If you're already doing it, you just remain in that cycle. But yeah, definitely worth a recap for people. Yeah.
So everyone's got their gifting allowance of 3,000 a year. That's the amount you can gift without it being part of your estate from an inheritance tax assessment. And if you haven't used last year's, you can look back 1 year on that, so a total of £6,000. And that's from the individual gifting. It's not to the person. So if you have 4 grandchildren, it's not 3 lots of 4. That's a misconception. It's just one as parent, as mum or dad or whomever. So that's a good one to consider every year. We've obviously got gifts such as gifting for weddings or small gift allowances. I know they're on the smaller, less common side of planning, but worth considering. And I think the biggest one, as we alluded to earlier, didn't we, Sam, is most likely going to be surplus income. So that bespoke meeting with your financial advisor, looking at what your income is this year, looking at your expenditure, and figuring out what you can afford to potentially gift away without that 7-year rule applying. That's a really critical thing to consider.
Yeah, we're definitely going to see more of that going on in the years ahead, undoubtedly. Yeah.
So that's something I'd really encourage for you to seek advice or on rather. And also there's some nuances, for example, how you structure your portfolio to provide income, what you're drawing down from or taking from, is that deemed capital or income? There's a little bit more to it. And it's really worth talking through with an expert on that side of planning. So I've started that conversation with quite a few clients. I'm sure you've done the same.
Yeah, certainly. Yeah.
Brilliant. Okay, so why don't we end on some tax year-end saving tips? Do you want to kick us off?
Yeah, so I think just a few bits that we've maybe not covered that will apply to some people, but not everybody. So yeah, high income child benefit charge. Just a reminder that those with earning that hasn't changed for quite a while. It's been stuck at £50,000 for a long time, where eligibility was sort of means tested between 50 and 60. That for the current tax year now is between 60 and 80,000, the means testing. So that's actually got more generous. So people need to look at that, and then they will need to include that on their tax return or by the end of next January. So yeah, just something to be mindful of. You also just the other thing to be mindful is those earning in or around £100,000.
Yeah, so that's sort of a real pinch point for individuals. But the biggest or probably most common symptom of that is your personal allowances reduced. For every £2 earned over 100,000, your personal allowance is reduced by £1. So we mean your rate of tax for earnings over 100,000 is as much as sort of 62% when you count for national insurance as well. So if you can do pension contributions to get you below that 100,000 mark, it's incredibly tax efficient. Not only that, and again, this is a little bit niche, but for those with student loans, often the amount you need to repay needs ratchets up. I think it's 9 or 8%, something like that. So your repayment of those can really ratchet up over 100,000. And the triple whammy, the third effect, if you're in this category, is those who are parents earning over £100,000 may lose their free childcare entitlement completely, which if you're a family of 2 children under 3 could mean missing out on £20,000 a year in childcare support. So if you are in that tax trap category, please seek advice, see what you can do to sort of reduce that effect as much.
Yeah, I think almost for those people, the cost of any advice is likely to be dwarfed by the tax savings available. And actually, I know a lot of employers are quite good in that area at providing some basic help. So a lot has been done around that area. But yeah, if you're not being looked after, please do get in touch, because we really can help.
And to finish off, let's have a couple more tax tips. Sam, take us through your next one.
Yeah, so I mentioned this earlier, but furnished holiday lets. Really something specific. If you're looking at selling, if you've got one of those and you're thinking about selling it, so this goes back to entrepreneurs relief and business asset disposal relief. If you think about selling those, that tax regime is getting even less generous. And so if you're thinking about selling those, again, get in touch just before the end of the tax year. because there's something that could be done to help mitigate the tax a bit further. It's not going to wipe it away, but it's a bit like the state pension, the ability to pay back in an unlimited number of years. That window is going to shut right in your face come the 6th of April.
And I know we have many business owners and perhaps tradespeople, so this may well still be applicable. But I've certainly reminded a few clients of mine that the double cab pickup tax regime is going to become less generous from April 2025. So if you are lucky enough to be able to place an order on a double cab pickup pre-April 2025 and receive delivery of that car, or rather pickup, pre-October 2025, you remain on the old regime. Again, very niche, but if it's applicable to you, it's something worth looking at as soon as you possibly can.
So it should be a good year end for sort of car salesmen then, Nick.
Well,
And it might tie in with their end of the year, so you might get a good deal on the purchase as well. So that would be
I mean, they specialise in that area. They're hopefully having a bit of a field day.
Yeah, okay. So I think that's everything for today. Loads of opportunities for us to continue having really good conversation with clients. Undoubtedly, there's a lot to talk about. So thanks for listening. You can watch all the previous podcasts we've made either via our website or via YouTube.
And also on Spotify. Thanks so much, Sam. It's been a great conversation with you today. I really appreciate your time. And I look forward to seeing you next week on our catch up.
Yes. See you then.
Take care.
All the best. Bye.